My name is Jake, welcome to the channel. In today's video, we're going to take a look at a Seeking Alpha article talking about what Jerome Powell had to say in Jackson Hole here this last week. So if you're a long-term subscriber of the channel, you know last year I was reviewing Seeking Alpha articles about once a week. And yeah, I wanted to bring that back. I thought that this was, I really enjoyed reviewing articles. And I wanted to, do it here about once a month, so you can kind of expect that from the channel going forward. In today's article that I wanted to review is titled What Powell Did and Didn't Say at Jackson Hole, and this article is from Jack Bowman. I'm excited to share that this video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to analyze my dividend portfolio. You can check them out with the link in the description below and use promo code DGI to get the very best pricing. So unless you're living under a rock, you probably saw that the market was pretty green here on Friday. And so, it sounds like that the Fed is likely to start lowering interest rates here in September. I think most people are pretty split on whether or not it's a good idea for the Fed to cut rates. People are very against it, they're very for it. And, obviously it's biased. They probably have real estate or something that's, impacting that. But for whatever reason, people have very strong opinions on this topic for good reason as well. And it seems like whatever the Fed ends up doing, it will ultimately probably be too late. Remember back during the pandemic, this whole transitory, I'd never heard of the word transitory before. And now it's like, whenever I hear the word transitory, I'm just like, ugh, shake my head. But, it feels like regardless of what's going on, the Fed will be late to the game. That's the biggest criticism of everybody of the Fed is the Fed's too late. The Fed being late to the game, well, it could look a little like this. Okay.
Canyon?
Gosh. Oh man, it got me. It got me at the end. Oh my gosh. Oh, love it. All right, cool. So what we're going to do is I'm going to take a look at this article. It's not too long. I'm going to read through the article. I'm going to share my thoughts and opinions. And towards the end, we're going to take a look at a few comments and then I'll wrap it up. But let's take a look at the summary here. So the summary of this article is that the Fed Chair Powell's Jackson Hole speech signaled a dovish shift with the Fed closely monitoring data and preparing for potential rate cuts this year. Now, if you're new to dividend investing or new to investing in general, and you've heard the word dovish and don't know what that means, it means that the Fed is likely going to be more accommodating and lower interest rates. Hawkish means that they're going to be more difficult. They're going to make it more difficult to borrow money. They're going to raise interest rates. Those are the two terms that you have to understand. Dovish means lower interest rates, more accommodating. Hawkish means that they're going to be a little bit more restrictive with monetary policy. So the labor market and GDP growth have both slowed, but Powell views the current balance as stable, though downside risks to employment are rising. So the Fed has basically two mandates. They're there to maximize employment and they're there to, keep inflation around their target rate of around 2%. So that's their dual mandate. And tariffs are pushing up inflation, but Powell expects these effects to be mostly one time, and not to trigger a lasting inflation spiral, although the Fed remains data dependent. So when I saw this and I listened to the speech from Jerome Powell, when he says one time, I'm just like, yeah. You wanted to say transitory, didn't you? But because the market has PTSD with transitory, he selectively used the phrase one time. I caught that. Pal. I see you. And then I hear Jack, the author of this article, I anticipate 2 rate cuts starting in September as necessary for a soft landing. The market shares this outlook, boosting confidence in stock indices. Are we still talking about a soft landing? Hasn't it been over like a year and a half, 2 years? At this point in time, like when do we stop talking about a soft landing? Okay, so the article here, it says the market and financial media were on standby all week waiting for the Jackson Hole Economic Symposium put on by the Federal Reserve Bank of Kansas City, where Fed Chair Jerome Powell would speak. There's no Federal Open Market Committee, so the FOMC meeting this month. So when there's an FOMC meeting, that's usually when the Fed will come and issue a statement on their monetary policy if they lower rates, et cetera, et cetera. So that's what FOMC meetings are. They happen a couple of times a year. So this was the next best thing investors could look forward to for monetary policy guidance. So let's take a look at the speech itself and decipher what Powell said and what he may have meant and what he didn't say, which made markets jump. So yeah, the market on Friday loved what Powell said. The market hit an all-time high. SEHD touched $28 a share. That was nice. My portfolio hit an all-time high. Dividend investors have been kind of lagging the market, well, especially if you're investing in SEHD this year. But dividend investing has been kind of lagging these last couple of years because rates are so high. Why invest in high dividend stocks when you can invest into a short-term treasury? But when rates come down, those short-term treasuries are, putting off a lower yield. So then investors have to reach a little bit more for risk for yield, right? So, that's why a lot of dividend stocks, higher dividend stocks in some cases, went up so much, because investors are going to soon have to look for new ways to generate yield when rates go down. So let's take a look at it. Powell's Jackson Hole speech. The symposium opens once a year, and so Powell starts off his speech discussing where the Fed was last year. So when I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25 to 5.5 for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risk to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 FOMC meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. So the first reference is the hawkish cuts, and, as I've been calling them, signaled by the larger cuts. So this hawkish part is what Jack is referring to, the author of the article, and signaled by the larger cut and then several smaller cuts before holding off and waiting through 2025 to see if they were having an effect. The effect has been that unemployment levels, around which 4% is considered natural, have not meaningfully moved in a year. Neither has inflation, which is slightly elevated compared to last year. And long-term bond rates, by the way, right? Do you remember, looking at the 10-year bond rate, for example, last September when the Fed cut the rate, and then the end of last year by a full percentage point, didn't the 10-year bond go up, thereby increasing mortgage rates? So they cut a full percentage point, and then mortgage rates ended up going higher. And when I was looking at that, I was like, what is going on? And so, you might be thinking, oh, if the Fed cuts rates, it immediately means that mortgage rates, for example, are going to go down. it's not a guarantee. I mean, we saw what happened last year, but I just wanted to throw that in there. I thought that was really interesting. Just because they cut rates, it doesn't have an immediate impact on the long-term rate. On the short-term rate, where you get in your savings account, auto loans, stuff like that, yes, it has an immediate impact, but on the long term, not so much. So the tone and wording here indicated that the Fed considered these levels positive. While inflation is still running above target, there's been a lot of talk about whether a 2% target is still realistic and whether the labor market can meaningfully improve from here. Powell then gets into the challenges, which he sees as largely coming from the fiscal and social political policy. He makes a clear distinction here between structural and cyclical changes to the economy and reiterates a point above how one-time changes to the economic conditions don't warrant Fed intervention. One-time, wink, wink, Fed, aka transitory. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the long run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. I kind of, brush this off a little bit because the Fed has been saying for years, we're going to be data dependent. When they're data dependent, why does, they're not even looking into the future anyways when they're being data dependent. So why do they even say this, right? Like, yeah, the future is, outlook is unknown. So we're going to be data dependent. It's just like, I don't know. It's a lot of blah, blah for me personally, but they have to say it. Whatever. So Powell's economic outlook. Because the FOMC operates by committee, Powell can't just go pull a level and change rates month to month, but his views of the economy are key to follow to understand where the FOMC will go because he still has an outsized influence, not only as a voting member, but as the chair of both the Fed system and the FOMC in particular. Next in his speech, he talks about the big three: labor conditions, gross domestic product, GDP, and inflation. And so starting with labor. The labor market is, in case in point, the July employment report released earlier this month showed that payroll job growth slowed to an average pace of only 35,000 per month over the last 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures of May and June were revised down substantially. This is why the whole BLS member, person was let go. For better or for worse, that this kind of sparked that, right? Because the revision in the job numbers. But it did not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. The labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of the demand for workers, and the unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. So the author here says that I've been signaling that the labor market will be what goes first if the economy starts to hit the hard landing that some pundits have been predicting will happen. But I agree with Powell's assessment that the labor market is in a curious state of balance. While the July jobs report that Powell mentions was a huge sign of weakness, he's also right that the report left out the context that both demand and supply are lowering together. That doesn't magically fix the issue of the deep revisions, but it does put into some perspective. Powell's mention of GDP was very brief, but there's a little talk about it since its growth was largely attributed to the AI CapEx than the consumption. So really important, the market has been held up by AI, artificial intelligence, capital expenditures from companies like Google, Meta, Amazon, buying, infrastructure from, chips from NVIDIA. That's basically where the earnings growth from the market has come from. Or the GDP, I guess. And not so much you and I just going to Walmart and buying our loaf of bread or whatever, right? So that's where it's coming from. And so Jerome Powell says at the same time, GDP growth has slowed notably in the first half of this year to the pace of 1.2%, roughly half of the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. The decline in GDP growth rate can also be attributed to importer-exporter behavior changes due to tariff policy uncertainty, where front-loading, buying ahead of time to create artificial surpluses, took place in Q4 of last year and Q1 of this year, with reduced imports in Q2 as businesses don't need to replenish inventory at the usual rate since many of them have these man-made surpluses to deal with still. So inflation was the big ticket item. So Powell made sure to get to it last of the big three indicators. Here's what he had to say about the currently sticky inflation rate. So turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the last 12 months, ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over the coming months with high uncertainty about timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift, aka transitory, in the price level. Of course, one time does not, he didn't actually say that, does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It is also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real income decline because of higher prices demand to get higher wages from employers, setting off adverse wage price dynamics, given that the labor market is not particularly tight and faces increasing downside risks. That outcome does not seem likely. Another possibility is that inflation expectations could move above, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So we're not using the word transitory anymore. We're using one time. So the author adds here, I was surprised at how dovish Powell was on the effects of tariffs, but was pleased with the comments about one time and all at once as we're seeing the tariff situation play out. One of these structural changes mentioned earlier is clear that the effects will not be all at once. It's also clear that the outcome will be multifaceted with some hit to consumer prices, some hit to producer prices, and hits to margins across the supply chain. This makes it difficult for the Fed to ascertain what pricing movements are related to tariffs and what are related to excess liquidity, creating outsized demand. I've been saying this even though the Fed is in an economic rock and hard place, they will cut at the September FOMC meeting. Powell all but confirms this with his conclusion for the outlook part of his speech. So Powell says, putting the pieces together, what are the implications of monetary policy? In the near term, risks to inflation are tilted to the upside and risks to the employment to the downside. A challenging situation. When our goals are intention like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in a restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So my opinion here is, why do they even talk about the future being unknown and difficult to foresee when he says that they will never deviate from being data dependent? Like, is it just me, or does that sound like kind of like, huh? Like what? What's it like? It's like it's just like a clown show. It's like, why even say it if you're just going to contradict yourself in your summary when you're going to say everything looking forward doesn't matter. We're only going to look in the rearview mirror. Come on. Like, this is why, like, I'm not here to bash the Fed, even though I'm kind of bashing them in a fun way. Like, just like, huh, really? This is why people are so frustrated with the Fed, and I think reasonably so. Now, that's not me saying that we need to take over the Fed and we need to, have a political party in charge of it. I think they should keep their independence. But I just think it's the way that they approach it is just kind of like, really, are we going to do this? Okay, anyways, the author writes here that this is as close to I'm leaning towards a rate cut as we're likely to get out of Powell. Insistence that they will remain data dependent is a cover, but it only covers so much of their intentions here. It's clear that more rate cuts will be necessary to keep the labor market healthy, and I maintain that we are most likely to get a 25 basis points cut in September and another in October before we go back into a wait and see period of holding rates for a few meetings. The market seems to agree that we'll get a rate cut in September now more than it has in the past week or month or so. So here, let me pull up this really quick. The poly market, this is the prediction market. They're saying that there's going to be a 77%, 25% basis cut in September. The Kalshi one, there's two of them. These are the two main ones. They're saying a 76% rate cut. This is basically just the betting market saying, what's the Fed going to do? And a lot of people like looking at the betting market because for whatever reason, when there's real money involved, this is generally what happens, right? So, like for example, in Vegas, if they're betting that the Bulls are going to beat the Cavaliers, 90-1, 90-10 or whatever, they're probably going to beat them. And so when real money is involved, a lot of people pay attention. So of course, new data that materially skews the trajectory of inflation or unemployment could cause a course correction. Monetary policy framework. I won't get too into this section of the speech, mostly because I find it inconsequential to the immediate decisions on monetary policy, but it should be of note that Powell said these lines during his decision on how the framework the Fed uses is changing. So Powell said in particular, we said that following periods when inflation has been running persistently below 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. We cannot say for certain where rates will settle out over the longer run, but their neutral level may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. We also continue to view a longer run inflation rate of 2% at most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor in helping keep longer term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in households and businesses in business decision making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Yeah, 2%, you don't really feel it day to day, I guess, but when looking back year over year, it really is that silent killer, when you look back on it. Just look at a Snickers bar. How small has a Snicker bar become, and how, I remember when a Snicker bar was like 59, I'm a millennial, and so it was like 59 cents. I'm sure all the boomers and, older generation, they can remember when it was like 19 cents, something like that. So it's just, looking back, it seems much greater than it feels. So the author continues here. All of this was essentially to say that the Fed used to view too low inflation as a reason to allow some inflation later so that a 2% average could be reached, but that this is no longer the case. In fact, Powell said that they may see a neutral rate higher than 2% that may be necessary to keep inflation down now that we are no longer in the era of super low inflation following the housing bubble. So the housing crisis of 2008, 2009, I'm assuming is what he's referring to. What Powell didn't say, there are structural changes coming to the Fed as President Trump continues his attacks on Powell and the Fed more broadly, with no signs of slowing down. At the next FOMC meeting, we'll likely have Stephen Moran there to push for rate cuts on the committee, something he has pledged to do. He has been dubious about the jobs data and so may threaten some of the data dependence the current FOMC prides itself on. So now the DOJ is investigating Fed Governor Cook, which may end up shoring up more seats for folks like Moran to hold temporarily and eventually for appointees to fill. I expect the people chosen for these positions like Moran to be aligned with President Trump's vision of immediate and steep rate cuts, and those views will flow into the FOMC as governors are replaced and empty seats filled. These changes may spur on rate cuts sooner rather than later, especially come May of next year when Powell's term ends and a new Fed chair will be appointed. I expect voting in the Senate confirmations to go along with party lines. Until then, expect the Fed to move at the current snail's pace with a few small cuts over the next few months and then a period of wait and see. What will be interesting to see is if long bond rates come down along short rates during the hawkish cuts we saw last year. Long treasury rates rose in defiance of the Fed. That's kind of what I was talking about earlier. Don't expect mortgage rates to come down immediately just because the short-term rate is lowered. I mean, we saw that, last year. So in conclusion, ultimately the Fed Chair Powell's Jackson Hole speech was a boon for markets because it demonstrated the Fed is watching the economy closely and that they are starting to turn dovish on rates again, signaling coming rate cuts this year. I still expect 2 cuts, with the first in September at the next FOMC meeting. Now, so does the market. If we get that cut, I expect the market to react positively. These are necessary for the Fed to reach its soft landing. It may take time for rates to be fully wound in, and we may see a higher neutral rate than initially expected, closer to 3% over the long run. If you were following the dot plot, you should have already known that, but hearing it from Powell is a confidence boost. The dot plot is where the Fed governors assume the neutral rate will be over the long term, over the next coming years. Thanks for reading. So that's the article. Let's take a look at a few comments, and then I'll wrap it up here with a few of my thoughts and opinions. So the first comment here, the economy has been in a soft landing for 18 months. The soft landing is about to end, not begin. So yeah, I think, with this whole term, the soft landing, I think, how long is a soft landing going to be considered a soft landing before we start talking about the next landing, right? The landing from this tariff. Like, why are we still talking about the soft landing? I don't know. I just think that's interesting. Another comment here is, I trust Powell to do the right thing at the right time. Now, this comment spurred a lot of controversy, or a lot of differing opinions from different people. So one person wrote here, like cutting interest rates less than 2 months before the 2024 election, unheard of until Powell did it, like saying inflation is transitory and then watching inflation rise to almost 10%. That's why this is such a polarizing thing, because you can look at this so many different ways. And I get why people are frustrated. And another person responding to this comment, I trust Powell to do the right thing at the right time for the first time. So people are not so happy. Another comment here, both of what he did and didn't say were enough to propel the market higher for the next 6 months. No signs of recession, and the economy is chugging along. Nothing to worry about for now. Yeah, I mean, right now it's difficult. You can't really say what the risks are, because that's the definition of a risk. You don't really know until it hits you. So for now, it looks like clear waters, but you just don't know until it happens, I guess. And the last comment here, great breakdown. Thanks for the detailed recap. Very compelling, though I found parts almost too detailed. The politics section in particular felt a bit far from Jackson Hole. Also, I would have liked a clear link to concrete investment implications. Still excellent work and very informative. Yeah, that was kind of my opinion here. The article, it breaks down what Powell said and didn't say fairly well. I guess what I would have liked to see is more of a recommendation, or, kind of a hint towards, hey, well, these are the implications of this of this meeting. This is what you can do. He did, the author of the article did touch on it a little bit with the short and long-term rates. So he did touch on it a little bit with bond rates. So yeah, it would have been nice to have and now what? What comes next? So yeah, overall, I think Jack did a great job on summarizing what Powell said and didn't say, the meeting here in Jackson Hole. I think he did a good job with the overview of, the 3 main things, the economy as a whole, what's going on there, the labor market, and inflation. I liked how he talked about the short and long-term bond rates. This is most important to most Americans, most people, because, the housing market is directly tied to interest rates. Whether you rent or you own a home, the cost of capital is directly correlated to interest rates. And, if interest rates are not going to come down, even though the Fed's cutting, that's a huge head scratcher. Like what's going on, right? It may be a signal that, the Federal Reserve Bank thinks that, or the investors think that, this, even though rates are down, we don't buy it, right? It's going to be difficult to say. And I think, the mortgage rates are not going to really get impacted until, next year, when inevitably, and I'm going to say inevitably because that's my opinion, when this administration basically does a rehaul, reorg of the Federal Reserve. I'm not a political person. I'm an investor, and politics, geopolitical things, what's going on in the world, it impacts my investments. And that's why I like touching on it. When I look at this, for better or for worse, next year interest rates are going to be lower. And you as an investor, as a homeowner, as a renter, have to understand the implications of that. Whether that's right or wrong, that's for you to decide. You have to figure that out for yourself. In my opinion, for asset holders, those of you who own assets, own stocks, own real estate, you're going to do incredibly well with that, at least in the short term, right? You know, in my opinion, you know, looking at the last couple of years, we're kind of in a boom or bust economy, right? We might have a major boom like we've never seen before. And then in a couple of years, you know, say we have a shuffling, you know, politically, we could see a massive correction, right? You just don't know. And so that's why I love dividend investing so much, where you're focused on the cash flow of your investment versus the share price. So my major takeaway from this, the article and what Jerome Powell said in Jackson Hole, if you don't own assets, you're going to get left behind. That's the takeaway. But yeah, I'd love to hear your thoughts. If you haven't already, go check out Snowball Analytics. And thank you so much for watching. And I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.